Hi, everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 73. This one is titled The Mid Contract Unwind Exit Strategy at the End of a Contract. We're going to show you a real life example with three exchange traded funds. The tickers are SH, which is short for the S&P 500. So as the S&P 500 moves down, SH will move up. It's an inverse exchange traded fund. And then we have two select sector spiders, XLP and XLV, which represent the consumer staples and healthcare segments of the S&P 500. So they're directly related to those sectors of the S&P 500. When they go up, these exchange traded funds will go up. Now, the mid-contract unwind exit strategy is normally reserved for the middle part or the early part of a contract. In this particular podcast, I'm going to show you that in highly volatile markets like we had in March of 2020 relating to the COVID-19 crisis, you can actually use this strategy even towards the end of a monthly options contract. So let's first discuss what is the mid-contract unwind exit strategy. Situation here is when the price of the underlying security after we've written a covered call actually starts going up significantly, leaving the strike price of that covered call deep in the money. So the strike price, of course, remains the same. Share price moves up, leaving that strike deep in the money. Now, one of the characteristics of deep in the money call strikes is that the time value component will start to approach zero. Now, the intrinsic value, of course, will go higher and higher, but that will be neutralized by the additional share appreciation we get once that contract obligation is removed. So we're focusing specifically now on the time value cost to close, which again is approaching zero. Now, normally, because we want to make sure that the time value cost to close is approaching zero, but will be able to generate at least 1% more than that, normally the MCU, mid-contract unwind exit strategy, applies only to early and the middle part of a contract, not the end of a contract. But what if the current market is so volatile, like it was in March of 2020, that the implied volatility allowed us to generate significant time value return even in the last couple of days of a contract, which is what I'm going to show and discuss in this podcast. So increased market volatility will create potential MCU opportunities even late in the contract. Now, if we were to look at a comparison chart of the S&P 500 and the VIX, the CBOE Volatility Index, in March of 2020, you would see a very unusual chart pattern. First of all, the VIX was up a whopping 461% in that particular contract month, the calendar month rather, March of 2020. The S&P 500 was heading the other way, and it was down a whopping 29% in just 1 month. So when the S&P declines that much, inverse exchange traded funds will go up a huge amount. And that's exactly what happened with SH, short the S&P 500. So on March 18th, 2 days prior to contract expiration, when we almost never would use the MCU exit strategy, the opportunity did arise because of the huge implied volatility in the market at that point in time. So here's what happened. I was long 10 contracts of SH, and I was able to close those 10 contracts, the 27 strike, at $4.60. That seems like a lot of money, $460 per contract, and I had 10 contracts. However, it was the 27 strike. How much money did I get when I sold those shares after I closed the short call position? I got $31.49 per share, which was $4.49 more than what my shares would have been worth had I not removed that short call obligation. So the stock price went up 449. The cost to close was 460. What that means is it cost me 11 cents a share to close that position. Now the question becomes, would I be able to generate more than $11 a contract in the last 2 days of those contracts in March of 2020? And the answer was a definite yes. So I closed those shares at a time value cost to close of 11 cents. Here's what I did. I bought 400 shares of XLP, which is the select sector spider for consumer staples. And I purchased 200 shares of XLV, which is a select sector spider for healthcare. And then I immediately wrote covered calls on those positions. And the 6 contracts that I sold generated an additional $1,041, way more than the $11 a contract it cost me to close those 10 contracts, $110. So I had a net credit by using the MCU exit strategy with 2 days to go of about $900. So it was a terrific trade that I made in a very short period of time. It took me about 4 minutes to make that trade for $900. So let's summarize. Exit strategy opportunities can occur at unusual times. In this case, it was related to the huge implied volatility related to COVID-19. Now, we must be prepared and we must take advantage of these situations. So once I saw the time value cost to close on SH had gone down to 11 cents a share, I knew I had an opportunity to act, and I did. Now, generally speaking, and this is important, 99% of the time, MCU exit strategies are reserved for early to mid-contract, not the last 2 days. This was unusual. However, in times of extremely high market volatility, those opportunities may arise even for MCU much later in a contract. So, ladies and gentlemen, that concludes this BCI podcast number 73, the mid-contract unwind exit strategy at the end of a contract. And you actually heard, and some of you saw, actual screenshots taken from my own portfolio where I did this trading. So I want to thank you all so much for taking the time to listen to this podcast, in some cases watch this podcast. I hope you enjoyed it, but more importantly, I hope it puts cash in your pocket. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.